Welcome, everybody. This joint presentation between Stony Hill Advisors and Whitehorse Investments. And Keith Conway is presenting on behalf of Whitehorse. He's our guest today, and their company is an expert in real estate transactions. So, but I'll just kick it off with introducing Stony Hill, and then I'll be quiet. Stony Hill Advisors is a lower middle market M&A advisory firm. We focus on companies between typically 5 to 50 million in revenue, but that's not a hard rule. We work with smaller companies and bigger companies, but this is our sweet spot. And we help them find buyers, and we also help them make acquisitions. We represent them on the buy side. Oftentimes, that is the best way to increase the value of a business is through acquisition. Interestingly enough, people don't recognize the fact that if you're buying a company that has a successful positive cash flow, it's generating real cash, the bank will lend you the money readily to go make that acquisition. And the cash flow of that company you're acquiring will pay a large percentage of the debt service on that loan. So you basically are getting making acquisitions almost for free. And at the end of the day, in this case, 2 + 2 will equal 6, because your company plus the revenue and employees and customers and products of that company you acquired make your business that much more valuable. We also offer, in advance of the process of making an acquisition or selling your company, we do exit value planning. It's a service we've coined from combining exit planning, which is a process of basically getting the business documentation ready, but also it includes focusing on the value components for the next buyer. The next owner is going to appreciate certain things in a transaction, one of which is how readily the owner can transfer the business to the next owner with a certain amount of minimal involvement with the selling party, because so the business is ready-made for the buyer to take over and run. The processes are in place, the employees are trained for the purpose of the transition, the customers are aware. Now, it's a process, but it takes time, and we help people get ready and allow the transaction. And then underneath all of that is our valuation service. And the valuations are interesting in the lower middle market. It's more than a calculation. And what I mean by that is two companies with the same revenue and the same profit don't generate the same value in a transaction. And there are a lot of reasons why. We explore those reasons. And the simplest explanation is when most people value a business, they take samples of competitive transactions, like you would anything you would buy. You look at who bought it previously, what did they pay, and it ends up being a bell-shaped curve in a given industry. There are some businesses on the high end of that curve and some businesses on the low end. We help figure out whether you're on the high end or low end, and we give you a better estimate of value based on where you fit, not just on the median. The median is a calculation, but it doesn't prove what you'll be able to get in the market. So that's probably enough about us. We have people from Ohio to Connecticut and everybody in between, all locations in between, and that's my story. So Keith, why don't you take over?
Thank you very much, Paul. And excited to share what we believe is a very important topic here for particularly business owners as well as advisors who are working with business owners trying to think about how do you optimize the value of the overall portfolio. And a lot of times real estate is a meaningful piece of the business, and you can't forget about the value that can be brought. So, what we're really going to discuss here is, that topic, some ways you can think about, some strategy you can take from a tax planning perspective. If you're philanthropic, different ways you can leverage being, contributing to charity, and other things you should just keep in mind as you're thinking about your real estate and ultimately preparing from some sort of business exit. So over the next 45 minutes, we're going to provide some tips to business owners when thinking about your real estate assets, share some market perspectives, generally what we're seeing more broadly, and then go through a couple case studies that I think are going to be very helpful for this audience. And at the end, we're going to carve out some time to take on questions. If you have questions throughout, feel free to just throw them in the chat, and Paul can help facilitate that. Paul shared a little bit about his background and the firm, Stony Hill Advisors. I am the co-founder and president of Whitehorse Capital. Whitehorse is a real estate investment and advisory firm. On the investment side, we operate as investors and the private equity side. On the advisory side, we do a number of things to really help clients think about their overall portfolio, with our main objective is to help clients preserve and grow their wealth. In terms of our team's background, it's a mix of large finance, accounting, and management consulting individuals who have come together, who previously had ties to real estate, but have really come together to form this consulting business that generally focuses on high net worth individuals and business owners. And our primary goal is to help them, again, preserve and grow their wealth. Just to get a little bit of a flavor from the audience, what we'd like to do is just start out with a poll. Before we jump into a lot of the strategies, have a little fun, try to better understand the dynamics of our community here and our participants. So I'm going to ask Paul to release a poll quickly and go through 3 basic questions here.
Here we go.
All righty. First question, do you own real estate associated with your business? Yes or no? Second question, does the dollar value of your real estate greatly exceed the value of your business, more than 2x exceed the dollar value of what you believe your business to be? And then thirdly, do you have a formal real estate strategy in place to optimize the value of your business exit?
So we'll leave it up for a few minutes, see how many people respond, and we'll tell you the results.
Let me just give it another 10 or 15 seconds. All right, let's see the results.
Okay.
So first question, 80% of the participants, and panelists could not take this survey, so 80% of the participants have real estate associated with the business. About 20% say that the value exceeds the value of the business. So 70%, the value of the business is meaningfully larger than the real estate. And 100% of participants do not have a real estate strategy in place to optimize the value of business exit, which is very intriguing. And hopefully, the content we're going to go over here can be instrumental in kind of setting the foundation for you all to have some sort of strategy and think a little bit more proactively about your real estate portfolio. At a high level, very quickly, a little bit about Whitehorse. Our advisory business encompasses a number of services ultimately geared at maximizing value. Among our core partners, we advised about $500 million in transactions. I have over 30 years of real estate experience combined with national reach. We're headquartered in New York, but we've done deals across the U.S. And worked with clients across the U.S. And we have collectively 25 years in corporate advisory. The advisory side of our business, really has kind of 2 verticals, right? The investment side, where we will provide expertise and opinions for landlords on sales, purchases, and management. And the wealth preservation side of our business is really working with those clients to, again, help preserve or grow wealth of current owners. Our focus of today's conversation is going to be a subsect of that second vertical, where we're really thinking about particularly business owners looking to exit. How should they be thinking about real estate as a whole, both their personal real estate as well as business owned real estate. As it comes together, a high level of our wealth advisory business, it's the name of it is Inspire Consulting, and really what we do at its core is provide family level office real estate services to families, businesses, nonprofits who don't necessarily have the need or access for fully dedicated staff. We work directly with our team's client of our client's team of advisors, attorneys, accountants, any sort of consultants that they may work with, to really bring comprehensive solutions to their real estate. So this would include things like efficient tax planning and things like tax deferment strategies such as 1031 exchanges that we'll get in, leveraging real estate for charitable giving, and again, thinking about how to mitigate taxes through that process. Secondly, revenue accretive strategies such as redevelopment or leveraging your land or your rooftop space for solar panels and EV charging, and us kind of helping facilitate those leases and those negotiations to make sure that you are driving value when going through that process. And the third is outsourcing strategies such as asset management, alleviating a lot of the responsibilities you own day to day, property management, et cetera. At the end of the day, what we do is really operate as a trusted ally to our clients, help them navigate all of the complexities that are associated with real estate. Because at the end of the day, what they're trying to do is run your business. So we want to help kind of create better, more profitable outcomes as it relates particularly to your real estate. Today, we're going to go through 5 things. We're going to start out sharing some tips for how you should be thinking about your real estate in the context of your business. Second topic is discuss some of the difficulties that are associated with real estate. Third is to provide an overview of several alternative strategies that can be used to optimize the real estate value. We're going to go through a couple case studies. Again, in trying to prepare for this, Paul and I put their heads together what would make sense for this audience, and I think we have a couple great case studies that will hopefully resonate, kind of open your eyes a little bit of some of the strategies you can actually take. We love having tangible things to take home and put in action. And then fifth, happy to take questions and or follow up offline if it's most helpful. Quick disclaimer before we jump into it: we're not providing tax or legal advice, and would recommend that before you pursue any of these formally, speak with your accountant, speak with your attorney on the various structures. If it's helpful, if you don't have a great tax attorney or real estate accountant, we'd be happy to connect you with some of the best in class folks that are in our network if you need a great referral. I like to start where we're hopefully going to end and give you something tangible to think about up front. And those are generally key considerations to maximize the value of your real estate, and then some proactive measures you can be taking on the front end when thinking about your business exit. So we'll dive into some specific strategies after this, but first and foremost, let's start with those considerations. Is the real estate owned by the business? Ask yourself, does the business outright own the real estate? Do you own the real estate and lease it out to the business? Those will actually change how you should be thinking about, different ways you can think about exiting your real estate and the tax incentives associated with each. Does your buyer want to buy the real estate? Do you want to sell the real estate? Oftentimes we see with a lot of these private equity roll-ups, they're kind of leaving real estate outside of the acquisition. And oftentimes, you'll have sellers who don't necessarily want to get rid of their real estate and may want to lease it back. So an important question to consider when thinking about how to maximize value: does your business occupy the entirety of the space? Is there any additional income being produced from your real estate aside from the full business use? We oftentimes see subleases, different parts of the business. Again, things like your rooftop being leased out. So make sure that you're thinking about all of the income that is being produced for the real estate when you're trying to think about its value. Next is your business lease showing market rent. This is an important one, right? You as business owners know that, especially if you own the real estate, you can be thoughtful in the best way to kind of show some of your expenses and how to be efficient from that standpoint. Ultimately, when you're exiting, you want to make sure that you're showing a track record of market rent to make sure that when the assets are valued, they're looking at what would be the fair market value of that asset. Have you gotten an appraisal recently? Oftentimes, you may have gotten an appraisal a long time ago. The real estate market has appreciated meaningfully over the past few years. So make sure you have a general number in mind for what you believe the value of the asset is. And again, that should be independent of the business. And then, lastly, exploring creative sale arrangements. So one example is an installment sale. It can be a great tax planning tool. Make sure you're considering all of the potential strategies that you can take to try to mitigate some of your taxes. Proactive measures when thinking about your real estate. I mentioned this a little bit earlier, but try to get your real estate appraised. And that should be, again, independent of the business. So make sure you're kind of looking at the value of your business, but also what is the value of the real estate on its own. Clearly define the ownership structure. Can't say this enough. You would assume this is simple and straightforward, but oftentimes it's not, especially as you think about, people who have taken, business has been inherited over a few generations. You may have, it's set up in C Corps, S Corps, trusts, LLCs. It may be owned by business partners, family members, brothers, sisters, cousins. And you really have to make sure who ultimately has the power to make those decisions. So clearly define the ownership structure and ultimately what happens with those proceeds following the sale. If you are getting additional rent from other areas of the real estate, ensure those leases are close to market rate. Especially important if there are those, kind of subleases out throughout the real estate. And then, what does this really come back to? It's, understand that it's the tax implications of the sale. When you have real estate, you can actually you can get a little more creative on optimizing the bottom line. So we like to say it's not what you make, it's what you take home. And leveraging your real estate allows you to be a little bit more creative on ways to optimize the bottom line. And we always recommend spending time on the front end, thinking about the different options available. These problems come in all different shapes, sizes, and flavors, depending on what you're trying to solve for. But if you have a great team behind you, you can ultimately get to the right place. A little bit about the why, right? Why is it overwhelming? Why is it difficult? Like, what are some of the problems associated? Real estate planning is overwhelming as a whole, and there's a lot of decision points, and there's a lot of potential decision makers along the journey of owning real estate. You may be dealing with business partners or family members who just generally disagree with reinvesting or some of the capital expenditures associated with the real estate. How do you ultimately get to some sort of resolution? You may get conflicting advice from different advisors you have in your network. That can be accountants, lawyers, financial advisors, brokers, and it may be overwhelming to get all these different opinions that may have different vantage points as to why they're providing that opinion. But you're kind of stuck in the middle, playing this role of collecting information, trying to figure out what's best for you. You also may be dealing with regulatory changes. So, like I said, we're based in New York, and a key theme that we're seeing from some of our larger property owners is Local Law 97 in New York City. And if you're unfamiliar with what that is, starting this year, the city, if you're in the 5 boroughs, now requires buildings over 25,000 square feet to meter and report their carbon emissions to the state. And if you do not report, or if you fall above the certain threshold that's allotted to you, you risk a fine, which they expect to be annually $200 million over the next, call it 6 years, until the fines actually get worse in 2030 is what they're expecting, to which they expect it to be $900 million in annual fines. So there's a number of camps, and like I said, all of these decision makers, decision points, a lot to handle when you and your role is to run your business, right? So a lot of different considerations, and unfortunately, what we have seen is this leads to lack of action, which ultimately leads to erosion of value over time. So you have to be proactive. You have to take measures. You have to make sure that you are in line with your team of owners. And there's a lot of, the landscape is just different today than it was 10, 15 years ago. But there are ways to make some of these headwinds into tailwinds, and really, try to drive additional value if you are thoughtful about the best approach. I want to talk about some of our client narratives that we see from individuals who have recently sold businesses or just business owners in general. Things like, I don't want to sell because then I have to 1031 exchange, which again is a tax deferment strategy. I want to hold a note to avoid taxes, etc. A lot of it comes down. You well know that the name of the game is trying to think about how to kick the tax can down the road. A Section 721 election is a tax strategy, and it can be a powerful tool to avoid a 1031 exchange if a client doesn't necessarily, or you don't necessarily want to go down the path of a 1031 exchange. What it really does is allow investors to contribute their property to an investment vehicle in return for shares of that vehicle. So I'll spare a lot of the technicalities for an attorney, but just to give you a flavor of how the process actually works, you can contribute your asset to a Delaware statutory trust, also known as DST, which is a diversified, passive, and more times than not, often institutionally managed real estate investment vehicle. After a few years having exposure to DST, your shares will convert into an UPREIT. An UPREIT is an umbrella partnership REIT, real estate investor trust. So you own some shares and the REIT owns some shares. And when you hold UPREIT interest, what's very interesting about this approach is that essentially that creates an ongoing coupon for you. And you're able to swap that coupon out for REIT stock at any point. The reason why this is largely explored is because after your passing, it's a great estate planning tool. After your passing, the REIT will give you stepped up basis, so you don't necessarily have to pay taxes on that. And for your heirs, they're holding REIT stock, which is highly liquid, much easier to bifurcate between children, grandchildren, cousins, etc. And they kind of make their own decisions. Either some may want to hold and continue to take value in the appreciation. Some may want to have a liquidity event at that point. You can even borrow against it, right? So there's a number of ways. But what it does is kind of create liquidity from an illiquid asset, kind of get a lot of those tax benefits that are associated with the appreciation that has come on, and you've deferred that, and then you get the step up in basis, and the heirs can figure out what makes sense for them individually. It's a great way to essentially backdoor into a REIT, but only really makes sense for a client who's not looking for short-term liquidity. But what we've seen, particularly as a lot of these highly appreciated assets are coming into market, and REITs have gained more adoption in the past 10, 15 years, this strategy specifically, we're seeing a lot more increased frequency behind it. Second, as we have seen business owners exit, it kind of comes the classic, get into a business, scale the business, and then once you've scaled and sold, you kind of come back and you start thinking about how to give back. And what are ways you can give back to charities or nonprofits that have a meaningful amount of interest to you? How do you really kind of leverage your real estate to do that? And something that people should take away is cash is effectively the most inefficient way to contribute to charities. It's the easiest for them to accept. However, there are a number of ways that you can think about contributing stock, business interest, real estate, etc., to nonprofits. And one of those examples is a charitable mandate trust. It's a great tool for highly appreciated assets, and like I said, can also be leveraged for real estate. The benefits are significant, and I'll just share three up front. You get an upfront tax deduction. You can create potentially a lifetime annuity. And from an estate standpoint, it removes the real estate from your taxable estate. So the property moves outside your taxable estate. So for somebody who's charitably inclined, thinking about giving back, really want to have impact, it could be a big donation that could come with benefits, depending on the size and scale, right? But think about how instead you can give in cash. Think about the meaningful contribution that can have with highly appreciated real estate. And again, you take out a lot of the issues associated with paying capital gains and whatnot, or I should say defer a lot of that. Lastly, on this page, client narratives. Often I want to sell, my partner doesn't, or someone has gone on title years and years ago and may not benefit from the stepped up basis. How do you unwind that? I'll start out on the partner wants to sell, but I don't. These are kind of advanced 1031 strategies, and these problems come in all different shapes, sizes, and flavors. What we really like to do is try to understand what your goals are before we recommend some of these. But for the right scenario, some of these strategies make sense. And again, a drop and swap will share a little bit about how that process works. essentially works for a scenario where, like I said, one partner wants to sell, another partner may want to reinvest some of those proceeds. So they both want to sell, but one wants to reinvest, the other wants the liquidity event. Typically, this involves, I say, the drop portion of this refers to the act of changing the structure of the ownership right before that tax deferment strategy of a 1031 exchange. And really what it comes down to is converting partnership interest into individual members' interest. Essentially, a partner drops down to an individual member. And after that drop, practice or strategy has been done, then there's a swap portion. That comes a drop swap. And they swap the portion of their property into a 1031 exchange. So really what this does, if there are two partners, it gets much more difficult the more partners you have, much more expensive as well. But again, just from like, if there are two partners, what this does is kind of separate the proceeds and really allow for independent investment goals. If someone wants to reinvest, if somebody wants to, pull out and sit on that cash and pay taxes, etc. So there are a number of scenarios that can come up. If you think about, someone being on title, what's the best way to unwind some of that? Again, it can be costly. What we recommend is just get ahead of it, right? The last thing you want to do is be on the 1 yard line with a potential buyer and then say, oh, I need to run into all these different scenarios to unwind some things that have happened, and I want to be a little more tax efficient, and we need to move out of a C corp or an S corp. Like, just it becomes more expensive. It becomes harder to get done. We recommend get ahead of it, get a strategy in place. At a minimum 6 months, we recommend a year of planning, and again, it kind of bring in the right partners to help you think about all the options available to you. I'm going to go through a case study now and talk a little bit about one of our clients that we have deemed Aunt Carol. And Carol was a real entrepreneur on Long Island who owned 3 commercial properties. One was a warehouse where she held her inventory. Her business was Scholastic Fairs. If you remember when you or your children were young and they were in schools, go to the Scholastic Fairs, that was her business. So one of those commercial assets was a warehouse where she kept her inventory. The second commercial asset was a retail strip where her office was, but there was also additional space there that she would rent, create income from. And the third was an acre of land further out on Long Island, a bit east in Suffolk County. Her goals for these assets, again, as you're trying to think about how to exit in the next few years, are really threefold. One, how can she maintain cash flow from these assets to pay for her grandchildren's college education? The second priority she had was she had children that were, professionals and successful on their own. They were on Wall Street, as a nurse, and they had no interest in taking over the family business. Didn't necessarily want to sell and pay capital gains, wanted to keep the equity she had built in these assets, but she wanted to take out all of the management responsibilities, alleviate the management, just kind of, maybe she's willing to pay a little bit more, hire an asset management firm, hire a property management firm, but really take the day-to-day responsibility out for her children, who, again, were all in their respective industries and not necessarily jumping into the business. And then the third priority, mitigate taxes and cash outflow. So she wasn't looking to reinvest, particularly in the land, to take on something a little more speculative. What we really did with Aunt Carol, we kind of, our process is generally 3 steps: consult, sit down, figure out what the goals are, where she is, engage, come up with options, lay out 3 to 5 different options that may work, sit with her accountants and lawyers and ultimately family members to figure out what makes the most sense for them and their estate, and then move to execution, right? Like, let's pull in the right parties. If you want to do development, if you want to do some sort of transaction, and ensure that kind of we're there through the life cycle. Just to give you a flavor of the actual outcomes that were taken. For the warehouse, we primarily looked at this opportunity as a sale leaseback and took advantage of the fairly hot warehousing market that we've seen since COVID. and we embedded a lease into it. So really what this did was help capitalize on a market and get a pretty high value for the asset due to her signing a lease and having a long-term tenant in place. And again, as she is shifting her mentality towards, I'm going to be selling, she wants it to more be of a local individual, again, not kind of looking for that private equity exit, but she believes that over time it'll be more attractive for a local buyer, given a long-term lease, has a place to settle and really kind of take the business to the next level. What this does, or what you were able to do, is defer the capital gains of the real estate by doing that 1031 exchange strategy into a triple net asset. For those who are unfamiliar with triple net, it's truly passive income. You alleviate all the management and expenses that you traditionally as a landlord are required to do. Generally smaller margin than if you take on some of those, but really what it does is create passive income. Oftentimes you'll see triple net leases with 7-Elevens, Arby's, sort of more like retail banks. Those are kind of the type of structures where you can generally find a fair amount of triple net opportunities. Next, for the retail strip centers come in all shapes and sizes. So just a little bit of market perspectives. Recently, we've seen the larger REITs, the larger players coming down market and moving into more kind of local town, mom and poppy type retail strip centers. They're looking to expand their portfolio and get in, and they're allowing their clients to do that Section 721 election that I had mentioned earlier. As I kind of alluded to earlier, there are benefits associated with it. You create a liquidity event. You can't 1031 into a REIT, but this strategy essentially allows you to have a very similar structure to a 1031 tax deferment strategy and get into the REIT. And then the third was the ground lease for redevelopment. So that acre of land out east. Many times when people own land, they view that as, I'm going to do something with it one day, and they just continue to pay taxes on it. And when they pick their head up and they may have the capital to do it, either they don't necessarily have the energy to pursue that action, or just becomes so capital intensive that they just decide to sell it. What we recommended to Aunt Carol was to do a ground lease, and similar to those triple net players earlier, these types of tenants who will take on ground leases are more common with bank branches and large franchisees. But essentially what the model is they will lease the ground from you for extended period of time, up to 99 years, but can be much shorter than that. You'll lease it out for a couple $100,000. They develop, so they construct the building on your land. They take care of all that cost and they run their business. When the land lease is up, you have increased the value of that land because you are the sole owner of that real estate. You can decide to sell at that point. You can decide to sell it to the tenant. You can decide to do something different with the asset, but really what it does, and what it did for Aunt Carol, was create a passive income stream off that property. And eventually, hopefully down the road, maybe your kids, maybe your grandkids will use that as a way to significantly increase the value of the estate. Second case study, this really ties back to charitable giving. And leveraging real estate can be very advantageous to your estate when thinking about philanthropy. And again, it's one of those tools that we highly recommend getting and start thinking about sooner than later. Is will work to your benefit. But if you are charitably inclined, as I said, cash donations are the most ineffective way to give to charity. Inefficient way, not ineffective. Very simply, right? So we're showing a side-by-side scenario here, and we have this modeled out for a bunch of different scenarios, but just very simply to try to bring it to life in a very simple scenario. You have an asset that was, valued or had a cost basis of $500,000. It has appreciated to a fair market value of $2.5 million. So it's appreciated $2 million. Simple assumptions: 20% capital gain, 35% federal income tax bracket. Ultimately, what you find here is you pay less taxes. So the scenario one, you sell the asset, you pay capital gains, and then you give the proceeds of that to charity. Scenario two is you donate the real estate to as an outright gift to the charity for a liquidity event. And then, as you'll see, you don't necessarily pay those capital gains. What the result is a 20% increase in the impact, 160% increase in the tax savings, which is meaningful. You can use that against against your estate. And then thirdly, you're condensing your overall estate. So if you're worried about 2026 sunsetting of some of the estate tax essentially being half, things you should be considering. 26 million going down to 13 million, 14 million going down to 7 million for individuals. This is one way to condense your overall estate, which people nowadays are, especially starting last year and over the next couple of years, really taking advantage of. So again, just what does this really mean? It means pay less taxes, have a more meaningful impact to the charity, and remove the asset from your taxable estate. Let's walk through another case study. So this case study is predominantly for real estate, and hopefully you guys are getting the gist here that the baby boomers are the ones who have all the highly appreciated assets across the U.S. So this one is Aunt Patty, and the context for Aunt Patty is that she's charitably inclined and has children that are no longer local. She was a fellow Long Island resident. Her kids have since moved on. And, as many business owners are thinking, they're trying to go south. They're looking for warmer weather. And she had a second home down in Florida where she's going to be making her primary residence, moving down there full time. Ultimately, Patty can set up a structure where she establishes income for the remainder of her life and leverages these real estate assets to do that, right? That's what she's trying to solve for. And the two opportunities that we worked for Aunt Patty to really pursue are one, a charitable remainder trust, and then secondly, an opportunity to get into a donor advised fund. Charitable remainder trust at a very high level, the benefits: deferring capital gains, receiving a charitable deduction, and getting ongoing distributions. Essentially how a charitable remainder trust works, for those who are unfamiliar, high level, contribute your highly appreciated business interest, stock, cash to a trust. The trust needs to pay out a minimum of 10% of the value to a named charity or multiple named charities. That value is of the overall trust value over time. 90% of those proceeds can flow back to whomever you want. It can come back to you as an annuity, it can come back to your children, it can come to different beneficiaries that you set up. So it's a very significant way to get upfront tax deductions, but also be able to benefit in terms of like setting up some sort of income stream for the ongoing estate, as well as you condense your estate. Donor advised fund is a little bit different, but essentially property is transferred to an intermediary who will sell it, and then the proceeds will go to the selected donor advised fund, which can contribute to a number of different nonprofits, or you can have it contribute to a specific nonprofit of your choosing. The benefits essentially are similar to a charitable remainder trust. The difference is you are trying to really get as much of a tax deduction at the sale as possible, and you're not necessarily concerned around an ongoing annuity stream. So the way it works is Patty receives that charitable deductions, and Patty receives charitable deductions for the fair market value of the charitable donation, and then the donor advised fund will administer and provide the grants to the selected nonprofit. So we're taking a step back and are going through a lot. Basically, there's a lot of options. There's a lot of different ways people can carve up how to think about estate planning, particularly if you're going through your business, how to think about charitable giving, if it's something you're philanthropic today, or your view is, when I have my liquidity event, I want to start giving back to these charities. Really what we try to solve for is, and what we recommend is getting ahead of it, thinking before the day of the liquidity event, but what's the optimal way to set up your structure on your real estate, set up various tax mitigation strategies, trusts, et cetera, to make sure that you're ultimately taking home the most value of your real estate. just thematically, why we think real estate is so important. You're likely aware of all the headlines around the great wealth transfer: 60 trillion, 80 trillion, 120 trillion, right? Whatever you think the number is, it's massive. And over the next, we fall with Fortune magazine that kind of puts it at 84 trillion over the next 20, 30 years. We've seen on the real estate side, in terms of U.S. wealth, as low as a third, as high as just shy of 50%. It's majority investment vehicles. So again, we'll kind of land at 43% of U.S. wealth is held in real estate. And Forbes says that 70% of wealthy families lose wealth in one generation. 90% of families erode wealth within 2 generations. Really, what that comes down to is poor investments, poor planning, and paying a lot of taxes. We think that, for individuals to not fall into that 70 or 10% camp, fall into the camp of people who continue to preserve and grow their wealth, you have to include real estate as part of your business exit, as part of your estate planning. And there's a lot of considerations you can get very thoughtful of, especially as real estate has just appreciated so meaningfully in the past few decades. I want to close pretty much how I started, right? At the end of the day, hopefully what you've taken away is that there are options, and you don't necessarily have to go to the market, try to get the highest value, sell, and pay a bunch of taxes. You really have a meeting depending on what your goals are, and you should start with your priorities, but really what you're trying to solve for. You can then filter out, okay, what avenue should I go down? You should consult with your team of tax and legal advisors to align on an optimal strategy. You should ensure that you're taking measures ahead of time to maximize the value. Don't wait until the last day, the last month, the last minute to take some strategies in place for your real estate. Explore creative financial arrangements, both for the real estate and for the business. Again, installment sales, one of a multitude of examples. Always remember, it's not what you make, it's what you take home. We're firm believers that you should be thinking about your net benefit. And that's really what I'll leave you with. I'm going to hand the mic back over to Paul. Thank you very much for all the time. And hopefully we were able to give you some helpful strategies, and then we'll open up for Q&A shortly.
Thank you, Keith. So I'll try to conclude, and we'll certainly have time for questions. And we offered this webinar today to put a spotlight on selling your business when you own real estate in the business or separately from the business. But if it's part of your estate or your business, you have to look at both sides of the equation. And one of the things we often recommend is don't start by selling the property, start by selling the business, because many times the buyer of the business would like to own the property as well. In the lower middle market that we serve, unlike in private equity, private equity firms don't want to tie up cash in buying real estate. Small business owners like to own their real estate because it gives them control. So oftentimes the buyer of the business will buy the real estate at the same time, or at minimum, they'll lease the real estate from you if you want to maintain control. And if you hold back on listing your real estate with a real estate broker, you save on that commission. In many cases, the transfer of the business, if the property is held in the business entity, the transfer of the business includes the property. There's no commission you would have to pay on the property specifically, because it's all one transaction. So there are always start with thinking about the business first, and then the property becomes a secondary part of the process. Next one, Keith. I'll just go on. This is I want to introduce our exit value planning services, and we've been doing this for a number of years now, helping small business owners. Again, keep in mind the marketplace we serve. There's a lot of issues in making a transfer of a business in this small domain. I've seen estimates that 80% of the businesses on the market, and these include mom and pop too, but 80% of the businesses on the market never sell. And the reason they don't sell is they haven't prepared the business for the next owner. And then it's a process of stepping back, and we use the term sometimes, stop working in the business, or minimize your effort in working in the business so you have time to work on the business. And we help with that process. We have created a platform that we call Stony Hill Academy. It's a learning management system embedded with many forms of additional content, from articles, videos, spreadsheets, and we've tied that back to our coaching services to help business owners understand how they can take advantage of the our Stony Hill Academy and implement a process that sometimes takes years. That's why we recommend get started early and work through the process of getting a business ready. The return on investment is huge when you invest some time in making the business ready for the next buyer. Okay, let's see, we have questions. I think the mics are off, plus we have a Q&A, and it's probably easier if you use a Q&A, because that way we can take them one by one. So type your questions and we'll answer them. I don't see any new questions coming.
Looks like I must have answered all of them, Paul.
Yeah.
So now I expect for everyone who said you don't have a plan in place, I expect that now you have a plan in place.
Or start the plan for your plan. Because it does take time. This is it's never a one-shot deal where I'll have everything covered in 2 meetings. It takes time, and
Yes.
It
takes
there are
team.
many dimensions too. So it's like a kind of like an onion, where you peel back one thing, you realize you have to do something else, and then you have to do something else. So I strongly recommend getting started. Even if you're not looking to sell your business, start working on it, and we can help you with our coaching. Okay, well, I won't keep people waiting. It seems like there's no new questions. I appreciate everyone's time today. And it'll take me a couple days to prepare the presentation and move it to a site where we'll send you a link that you can access this presentation at a later date. You can share it with somebody if you like. And I appreciate your time. And we do these every month. We haven't prepared next month's topic yet, but we'll be announcing it in a week or so, and hopefully we'll have some more good content for you next month. I look forward toward the middle to end of February, and we'll hopefully see everyone then. Thank you all.
Thanks, everyone.